Alright guys, so this is a supercut version of the best parts of my 2-hour-long discussion with my fellow mentors, Elson Chu and Bang Pham Van, which is, by the way, already live on the Piranha Profits YouTube channel. So if you want to watch the entire 2-hour discussion, do catch that on that channel. Now, we've shared exclusively on our upcoming expectations and opportunities we see in the markets today, so you wouldn't want to miss all this out. Now, led by the PP team, there's also a recently released expose video on my $12 million portfolio. So do check that out in the channel as well. We have a lot more exciting content lined up for you leading up to the upcoming live event. So I can't wait to see you at Black Market. And I'm sure you're as excited as I am to pick up a lot more ideas and strategies. Click on the registration link down below to grab your free ticket right now.
Welcome to the exclusive premiere of the Black Market panel discussion by Piranha Profits. So I'm Chi Keng, the host for today, and I'm extremely excited to have the opportunity to sit down with some of the best in their respective fields, regardless whether it's investing, trading, options, or even crypto. So I think the largest question on many investors' minds today is really what I would quote it as the holy trinity of the markets today. So you have interest rate concerns, you have inflation concerns, and of course, people are asking about recession. So I think I'll just start off, or get Adam to start off the entire discussion on what is your expectations of many of these three key concerns today.
Okay, so inflation, now inflation used to be about 2%, and then in mid-2021, it went up to 3%, and then it went up, and then it peaked at 9% in June of 2022, which was very, very high, right? But since then, inflation has actually come down, down to 3.6%, and is now on a downward trajectory. So you got to understand what created that inflation in the first place. So there are many things, but three main things. Number one was the quantitative easing by the Fed, which means they keep printing money and lowering interest rates. So that could have caused an inflation, all right? Number two was a supply chain disruption. So there was demand, not enough supply, inflation. And the third was labor shortage, especially in the US, where a lot of job openings but not enough workers. So that pushed up the wage cost. So all that created the inflation in 2022. Now all that has reversed now, right? So now the Fed is doing quantitative tightening, right? They're reducing the money supply, and then the labor participation rate is going up. There's more people are going back to the workforce in the US, and the supply chain problems have been resolved. So because of that, inflation has been coming down. And I think that the inflation more or less will be slowly going back down to 2+% pretty soon. Now historically, right, I'll show a chart right here. Whenever inflation peaked and came down, the stock market bottomed and went up. So again, inflation peaked in June 2022, and the market more or less bottomed in October, which was just a few months after that. And that's when we started the new bull market, right? So I think inflation, in the long run, I don't see a problem, because with AI and automation, for example, Amazon is now using a lot of robots to replace people in the factory. So that would reduce costs for businesses, increase productivity, and it's a deflationary effect. So I think long-term inflation should not be an issue to be concerned about, right? Now, for the interest rates, there's both the short-term interest rate set by the Fed and the long-term interest rates, the 10-year, 20-year Treasury interest rate. So the short-term rate by the Fed, I think, if you ask me, they are done. The Fed has finished their rate hike cycle, okay? And they may even cut rates next year, okay? Now, for the long-term rate, it's still going up. In fact, it reached 5%, the 10-year yield reached 5% a few days ago, but it's now back down below that. So I think more or less it's near the top. I don't think it's going to go much higher. And I think from there, we're going to slowly stay there or come down a bit. Now, with the long-term rate up, that increases the financing cost of companies. And that doesn't really affect the big companies that we invest in, like Microsoft and Apple and Google. Not affected. In fact, they're still doing well because they have a lot of cash. So they earn more interest income from the high interest rates. and they got very little debt. Okay, but what suffered from the high long-term rate are REITs. REITs got whacked, bonds got whacked, small companies got whacked, and consumer staple dividend stocks got whacked. So once the 10-year yield comes down, which I think it will start next year, then the REITs and the bonds and the small caps will start to rebound. As far as recession is concerned, everyone said we're going to have recession this year. Didn't happen, right? And I'll talk more later why I think everyone got it wrong.
So I think right now the yield curve is clearly inverted based on the graph, and there's a lot of talking points around yield curve inversion being a forward indicator for a recession. And because there's a recession, stock market will not do well because companies' earnings will get impacted. So do you have a particular read on this yield curve inversion, on whether it will be an issue?
Okay, so so far there's no recession even though the yield curve inverted, right? So I've got two theories, right? So one theory is that we already had a recession. And the recession happened in 2022, quarter one, quarter two. Remember the first 2 quarters of 2022 were two negative quarters of GDP growth, which actually is a technical recession. So actually maybe that was a recession, right? But it was not official by the National Bureau of Economic Research. The second thing is that we actually have had an earnings recession. So in fact, the last 3 quarters, the S&P 500 companies, the earnings growth was negative. Quarter 4 2022 was negative. Quarter 1, quarter 2 2023 was negative. And in fact, this quarter, which is now being reported, is also expected to be negative. So that means the companies already went through a recession and are expected to bottom this quarter. So to answer that question, my belief is that the recession already is here and over, right? But it's just not official.
Right. So earlier this year, I entered a couple of AI-related stocks because I see that they actually form a price action manipulation pattern. I see that big boys was accumulating the stock heavily. So I went in big positions in, I think some of you may know, during the 6th wave event, big positions in Palantir. I also entered in Tesla, right? So these are the major names in the AI play. And for Palantir, I really cashed out 3/4 of my position, realized about $150,000 of profits, and I'm still riding on the other 1/4 of my position. And based on what I see from the chart, I think we are likely to move higher because there's no signs of bearish price action for Palantir right now. And especially there's a narrative like Palantir, the possibility of Palantir being added into the S&P 500. So I think that will be a major catalyst for Palantir as well. Yeah. So I'm actively looking into China stocks as well, right? Because I believe that just like October 2022, when the Hang Seng found the bottom, many of the Hong Kong stocks actually did multi-bags return, right? And right now, I think as everyone know that the Hang Seng index is coming back almost, I don't think it will go back all the way down to the October 2022 low, but somewhere near there, if it forms a price action bottom, signs of bear trap, which is bullish, I will be actively looking for the underlying stocks, right, that also form similar pattern to trade them back up.
On a macro valuation perspective, if you look at the S&P 500, the forward PE ratio right now is about 18 times earnings, which is historically not expensive, okay? If you take away the Magnificent Seven, which is Meta, Google, Amazon, Microsoft, Tesla, Nvidia, and Apple, take away those 7, of which I own 6. The rest of the stocks in the S&P 500, the PE ratio is only 15 times earnings, which historically is below the historical valuation average. And if you look at the small companies, the small cap, the PE is about 10 times earnings. So I don't know what bubble they're talking about, right? If you look at the actual numbers. Now, if you do a bottom-up approach, if you look at the individual companies in the S&P 500, which my team, we did the research, I'll give you some numbers, right? And this is based on a discounted free cash flow valuation method. Right now, currently, about 29% of stocks in the S&P are fairly priced. Not cheap, not expensive, fairly priced. 55% are undervalued, and 15% are overvalued. So based on our research, no, there's no bubble in the market.
Right. So Bang, are you T-bills and chilling now?
Yes, I remember 2 years ago in this very same venue, I used to quote a trendy theme at that point in time. There is no alternative, TINA for short, right? But now, after 2 years, things have changed, and things have changed a lot. There is a serious good alternative right now, which is the T-bill, the US T-bill, where you can earn more than 5% on the short term, like bond, government bond in the US. And for me particularly, it is suitable for my situation where I decided to retire early. I adopt a more balanced approach whereby about 40% of my portfolio is now parked under US dollar fixed deposit and T-bill, where I earn more than 5%. And then the 60% remaining portfolio, I use option to turbocharge my performance. And the way I construct my portfolio that way is to help me weather all kinds of market conditions. It stabilizes when the market goes through volatility, and it also generates disproportionate growth when the market returns to an uptrend. Right? So that is how I have changed my portfolio allocations over the past, let's say, nine months or so. So this year, 2023, my biggest one has been Alphabet, Google, where in one single trade, I made $64,000 or 144%. So that's so far my biggest win in this year. Again, in one single trade, because I have multiple trades in different accounts. So if you combine all accounts, probably is $100,000 in Google itself. And then followed by Meta, $36,000, 156%. Amazon, $20,000, 93%. Microsoft, $30,000, 30% return on investment. And across my own accounts, I have 57% return on investment year to date. Now, the strategy I've been using the most, and also the most profitable strategies for me so far, has been the crouching bull spread, which I introduced last year black market, right? During the black market event. I also reintroduced it during the last 6-wave webinar. So that one has been the most profitable strategies for me in this year. Now, in the upcoming webinar, I'm planning to introduce a brand new strategy where I have tested it for the past 5 months, and the result has been very good. I have done 250 trades as of yesterday, achieving 86% win rate and very good return on investment. So just stay tuned. I will introduce it to you in the upcoming webinar.
So the first myth is that Wall Street has convinced people that professional investors, professional fund managers are smarter than you. They've got more resources, they've got more data, they've got more computing power. So you might as well let them manage your money because they're smarter than you, right? But it's not the truth, right? So the reality is that the majority of professional fund managers actually underperform the market index. So specifically, in a 1-year time frame, more than 50% of professional fund managers underperform the index. Over a 10-year time frame, over 90% of professional fund managers underperform the index. So what does this mean? This means that if you just buy the index ETF, you will outperform 90% of professional fund managers. You get better results than them without paying them all the fees. The second myth is that you should make investment decisions based on listening to the Wall Street experts, the analysts, the economists, and the fund managers. In reality, if you actually listen to most of their advice, not only will you underperform the index, but you may actually lose a lot of money. So let me give you an example. After the financial crisis in 2008, 2009, the bull market started in early 2009. And from 2009 to 2022, the S&P 500 index went up 500%. If you just bought the index, you'd have gone up 500%. But if you had listened to all these experts, you would have missed out on the 500%. So if you look at this chart over here, you can see that throughout that entire period, the majority of these experts were telling you that the market was going to crash, that the market bull run was not sustainable. In fact, most of the experts only said that the bull run started in 2012, which means they were 3 years late. Now, I wrote a book called Profit from the Panic, some of you will remember, which I launched in January 2009, where I shared about how I was buying great companies which were very undervalued. And that's how I made, well, my first fortune back in 2009, 2010. But again, most people listening to these experts would have missed out on those gains. More recently, in 2020, after the COVID crash, you guys remember I created a video that said the bull market is back in April 2020. And that's how I made over 40% return in 2020. But again, if you look at this chart over here, if you listen to the majority of Wall Street experts, most of them did not expect the market to go up. Most of them expected it to crash, and they shorted the market, and they missed out on the 40% gains. In fact, by the time Wall Street and the media told you you were safe to buy, the market was already up 70%. The third myth perpetuated by Wall Street is that, hey, if these professional investors can't beat the market, what chance do you have as a retail investor? But the reality is that a lot of retail investors, they don't realize that we have actually a lot of inbuilt advantages that if we learn to exploit, we can easily beat the professionals. So many retail investors, they're not aware of their inherent advantages and they don't know how to leverage on it.
Wall Street makes you believe that buying options is a way to make money, right? And lots of option traders, especially the new one, get lured into that idea that hey, you can use a small amount of money, capital, you could potentially get a big price or returns of it. In reality, buying an option is like you go to the casino and you keep putting coins into slot machines or the jackpot machine, right? Once in a while, you may get some small prizes, or if you're really lucky, you could get a bigger prize. But in most of the time, you would lose money. But you will tell yourself that, hey, this is just a small money. And then you keep putting more coins into the machine. And you end up with losing a lot of money. Now, when you are losing money, guess who make the money? Well, the one that owned the machine, right? Which is the operator or the casino himself.
So when I joined the prop desk, right, I realized that a lot of the top performing traders and even my former bosses, right, when they trade the markets, right, they are not using the traditional indicators. In fact, they were looking out for consistent patterns on how the market is being manipulated or rigged. And when I joined desk, I realized that it's not as simple as what people think, right? The market is rigged against the normal retailers. Okay, so in order to beat the market, you need to use discipline, risk management, and even skills to position yourself.
A high quality REIT is one where they're able to grow their gross revenue consistently. Of course, you can ignore the COVID period, right? But generally, gross revenue, net property income must be growing, number one. Number two, their dividend per share must be growing consistently as well. Of course, again, you can ignore that COVID period, which was one-off. And of course, maybe the last 1 or 2 quarters where finance costs went up and pulled down the DPU. But besides that, DPU should be also increasing. The other thing is to make sure the NAV per share, the net asset value per share, should be also increasing over time. And most important, the gearing ratio. So only buy REITs with low gearing ratios. If you're very conservative, make sure it's 40% and below. If not, at the most, 42%. But don't go above 42% gearing ratio. So those are for the REITs.
I'm still positive on the China-Hong Kong market in the long term. It's just in the short term, when I look at the price action, I see that there could still be further downside, but I see it as an opportunity. Just like October 2022 last year, right, when we see many stocks bottom out and rally massively and make multi-bagger gains. So right now, I'm actively monitoring the Hong Kong China market for setups and building my position whenever I see a potential price action manipulation setups in the stock. So in recent months, I've been building up my position in crypto, especially Bitcoin, Ethereum, XRP, which is the crypto majors. because I saw certain price action manipulation accumulation pattern, especially for Ethereum, okay? And I think my community knows about it, okay? Because I also share with them that I also invest in crypto as well. And I think that the upcoming narrative, for example, I mentioned about a Bitcoin halving and potential Bitcoin ETF, right? They will eventually come next year. And this has actually led to a lot of people FOMOing, fear of missing out into the price action. But I do think that once you have the ETF approval, when things get euphoria, it's actually time to sell, right? Buy the rumor, sell the news. And that's when I think after the sell-off, we form a base, then that's when I'll be even more aggressive to buy into crypto.
Sometimes the best advantages are staring at you right in the face. Like a lot of people I talk to, they say, Microsoft and Google and Amazon, everyone knows about them. They're so big, how much bigger can they be? How much can I make from that? And I think you're making a mistake, in my opinion, right? So the biggest positions in my portfolio are a lot of these big tech companies. In fact, the Magnificent Seven, excluding Tesla, I own all of them, right? Meta, Microsoft, Apple, and so on and so forth. And although they are already up double digit this year, I think they are still undervalued in my opinion. And they are in a long-term secular growth phase because they are the leaders in artificial intelligence and automation, especially Microsoft and Meta and Google and things like that. And this is something where the US leads, if you think about it. No other country in the world leads in AI the way the US is. And I think if you ask me, in the years to come, many countries out there would have to purchase the AI technology from the US to make their companies more productive. So to me, I think the biggest opportunities would be, again, in those companies, Microsoft, Amazon, Google, and Meta. Someone asked me a very interesting question recently that if I were to start all over again today with a small portfolio, where would I invest? I think I would start with these first, seriously speaking, all right? But besides this, I think there's a lot of opportunities in healthcare as well. Now, generally, I love the healthcare sector because healthcare is a long-term growth industry. Why? Everyone in the world is growing older, living longer, right? Especially in the US. So there's big demand for healthcare services. And healthcare is also a defensive sector. Meaning to say, in a recession, you still need healthcare. In a recession, you still need to go for operations. So it's defensive plus the growth industry. And this year, healthcare has dropped significantly for two reasons. Number one, the healthcare sector is what we call out of rotation. Remember that money goes in and out of sectors. It's like musical chairs, right? So every time money flows out of a sector, everything gets cheap. Money flows in the sector, everything goes up. So I love to buy when money comes out of a sector. That's when it gets cheap.
Remember to grab your free tickets to the live black market event happening soon from the 17th to the 23rd of November 2023. You can get your tickets by clicking on the link in the description below. So in the black market webinar, I'll be joining the stage with Elson Chu, an expert in price action manipulation, and Bang Pham Van, who's an options specialist, be sharing with you our latest insights into the markets, the strategies that we are using to really maximize our returns for the rest of the year as well as 2024. So grab your tickets right now.